morning in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, President Trump attacks social media on social media in response to Twitter and Facebook blocking access to a New York Post report about Joe Biden. Now, Republicans are demanding to see the CEOs of both companies on Capitol Hill. Plus, to go public or not to go public, when and how? Longtime venture capitalist and Uber investor Bill Gurley joins us to talk about the path forward for tech startups in a new normal. And driven by autonomy. We'll hear from longtime automotive executive Dan Ammon on his Cruise unit winning permits for robo-taxi tests without safety drivers here in San Francisco. My exclusive interview coming up. But first, stocks pairing losses today as traders awaited news on negotiations over a fresh round of stimulus amid a resurgence in cases of COVID-19 around the globe. For more, I want to bring in Bloomberg's Abigail Doolittle. Of course, we also know this has touched the Biden campaign and Senator Kamala Harris, a couple of her aides. Abigail, how did this all impact the markets today?
You know, another interesting day, Emily, a lot of fun to watch, actually, just because there were so much movement. Now, on the open, you had all the major averages down more than 1% in sympathy with big losses in Europe having to do with the resurgence of the virus. So I would argue that that was the main bearish factor on the day. But as the trading session went on, traders, the cooler heads prevailed. And at the end of the day, the S&P 500 down just a little more than 0.1%. The Russell 2000 reversed a greater than 1% loss to close up more than 1%. That index is more domestically oriented, so that would support the idea that there were fears initially around the European virus cases. The Bloomberg Commodity Index, another silo of the risk assets, higher, and a big piece of that copper, that of course is a tell on the economy. So similar to yesterday, there are nuances that suggest some investors are more optimistic about some sort of a reopening or a cyclical trade. However, where we did not see any sort of risk-on action was for the NASDAQ 100, down more than 1.5% on the open, down at the close, down 0.7%. So investors not wanting big tech. The really big drag, though, on the NASDAQ 100 was biotech. As for some of the leaders and the laggards on that index, and interestingly, Emily, that index down 3 days in a row, first time we've seen that in about 3 weeks. However, on pace for yet another up week, really being helped out by Apple. But on the day, Zoom really taking off, up 5.3% after yesterday's investor day. Traders and analysts, investors really liking some of the company's new products. Intel, from a point boost, was one of the bigger stocks to help the NASDAQ 100, up 0.6%. Then the big laggard on the day, Vertex Pharmaceuticals, down 21% at the lows. It had been down about 30%, its worst day at that point since 2003, after they discontinued a liver and a treatment that was expected to drive a new leg of growth for the company. So you can see those shares really getting punished. There were some of the other big biotech companies that were down in the day. And then finally, rounding it out, Tesla down 2.7%. And as you know, Emily, they have cut the price on the Model S twice this week. So perhaps some folks worried that that is a sign of waning demand. On the other hand, for a stock that's up more than 400% on the year through a pandemic, you know, when you see folks take chips off the table, in some ways it makes sense, Emily.
All right, Bloomberg's Abigail Doolittle there. Thank you so much for the roundup. And since you mentioned Zoom, we're going to be speaking with the CFO of Zoom, Kelly Steckelberg, later this hour on the back of that Investor Day. Turning now to Twitter and Facebook, Senate Republicans are demanding to meet with the CEOs of both companies to talk about alleged censorship of political news. This after both platforms put restrictions to slow the spread of a New York Post article about presidential candidate Joe Biden and his son. For more, I want to bring in Bloomberg's Ben Brody, who covers tech regulation in Washington. Ben, of course, the president tweeting about this as well. President Trump saying earlier today, if big tech persists in coordination with the mainstream media, we must immediately strip them of their Section 230 protections. When government granted these protections, they created a monster. Tell us the latest.
Well, I think what we're looking at is demands, at least for Jack Dorsey, but probably for Mark Zuckerberg, to address the Senate Judiciary Committee. What's particularly interesting about this is that they are supposed to address the Senate Commerce Committee, and both of these are supposed to happen before the election. So we could be having yet another big tech CEO hearing, if not two more, coming up in just the next 2.5 weeks before we have that little election on November 3rd.
So talk to us about the results of this on the companies themselves. These companies have said, we didn't do this out of anywhere. This article in particular conflicts with policies about hacked materials. You might know it as hack and leak, where one campaign might, releases materials that would damage another campaign. Talk to us about the impact on the companies themselves.
Well, this has been a really long-running battle here in D.C., at least going back to the Cambridge Analytica issues, where Democrats want the companies essentially to do more to take down what they view as political misinformation, conspiracy theories, foreign election interference, all those kinds of things. And Republicans increasingly are saying, you're taking down our stuff. You're censoring conservative views, conservative voices, and conservative opinions. And this seems to really be coming to a pinnacle here, where they're basically saying we're caught between a rock and a hard place. What would Democrats, and Democrats, I might remind you, could very well be in power next year here in Washington. The companies are looking at this and saying, what would Democrats do if we didn't take this down? But what are Republicans going to do if we do take this down? And that's a real catch-22 position for them right now. And I think they've kind of made a call that may or may not point to their thinking that there could be Democrats here in power next year, and they have to live with the fallout from that.
So let's talk about what's happening on the Section 230 front. Of course, the president has demanded that the FCC take this on. I just spoke with the chair of the FCC, Ajit Pai, yesterday. He was not too forthcoming about the FCC's plans, but you have commissioners who disagree that this is in the FCC's purview. How exactly do you expect this to play out?
Well, so Pai actually did tip his hand a little bit more just a few hours ago, and he said that he would be advancing that rulemaking that would kind of clarify or pare back, if you will, the protections that the companies do enjoy for that user content. This is a bit of a sprint. He does not have the votes right now. One of the Republican commissioners has said he doesn't see this happening. President Trump is trying to replace that commissioner. They would have to do that relatively quickly and move it through the notice and comment process that we have for rulemakings here somewhat quickly. They're kind of racing the clock if Democrats come into power. If President Trump gets another term, then it's not so much of a problem for him. But it does seem like that is actually moving forward, even as you have these efforts in Congress. And then just earlier this week, you have Justice Clarence Thomas, one of the conservative justices on the Supreme Court, who said that he thinks that this is too broad, and he really wants to revise about 25 years of jurisprudence on this.
All right, Ben Brody, much to keep watching. Thank you so much for giving us that update. We'll continue to follow any developments out of that story. Coming up, IPOs are hitting the market faster than ever in recent history. We're talking with legendary tech deal maker Bill Gurley of Benchmark to see what his expectations are for 2020. This is Bloomberg. IPOs are running hot this year as investors build an appetite for new stocks and opportunities. So far, there have been 309 IPOs on the U.S. stock market. Year to date, that is almost 75% more than the same time last year, in a pandemic no less, when many expected the IPO window to be closed. Longtime Silicon Valley venture capitalist Bill Gurley has been a vocal proponent of going public sooner rather than later. He's backed companies ranging from Uber to Stitch Fix. Benchmark Capital partner Bill Gurley joins us now. Bill, always good to have you on the show. Good to have you back.
Thanks for having me.
You've been out there a long time saying that companies need to go public sooner. Now we do see companies charging out of the gate. But when you look at how they're going out of the gate, I wonder if you think they're doing it the right way or not. For example, Snowflake going public, shares doubling on the first day of trading. Is that a victory or a miscalculation?
Well, look, I think any CEO that you talk to on the day of or day after a successful IPO is in a mindset of achievement and is not, and I completely understand this. They're not in a mindset of, oh, did I just make a mistake? But the process that we use to go public, if people spent the time to understand how it actually works, is the equivalent of using a paper map to do a 4-hour drive today. Like, there's just a much more elegant technology-enabled approach. And because of conflicts of interest and because there's a lot of money involved, there's a lot of people who want the broken process to exist and to continue. Unfortunately, it's getting worse. So last year and the year before, there were about $6 billion in underpricing across all of venture-backed companies. Jay Ritter at the University of Florida aggregates this data. Snowflake alone was $4.5 billion. Just one company. And so the day after the IPO, the people that were allocated the stock the night before have $4.5 billion in wealth they didn't have before. And that money didn't just come out of nowhere. And unfortunately, the process is getting worse. We have a wonderful new age alternative called the direct listing that just matches supply and demand. That's how Palantir and Asana just went out on the backs of Spotify and Slack. So now we're getting some momentum around that. But it's really night and day. Like I said, a paper map compared to using Waze.
Now, I know that you are considering alternatives, SPACs, direct listings. Some investors have been disappointed in Palantir's direct listing, for example. How should companies be considering their alternatives?
Well, look, I'm a firm believer that once you get out and are public, how you got there has no lingering effect on the company, right? I'll give you a list of companies that are pretty surprising list, but Amazon, Square, Proofpoint, Salesforce, Netflix, Peloton. Guess what all those companies have in common? They traded below their IPO price, just like Asana did. And in the long run, how you perform as a public company is all about your long-term cash flow generation and how you do in your market. It's not about how you went out. And so I just don't buy that there's any legacy from how you went out the door. Lyft went out with a traditional IPO. It's trading at half of the price it went out. Is that the fault of the way they went out?
Okay, so does that apply to Airbnb, which arguably waited too long to go public? I mean, no one knew a pandemic would happen, but that has potentially impacted their fortunes in the near term. Now they are getting out of the gate. We've reported it's happening in December, which will be post-election.
Yeah.
Do they miss a window if they do it that way? And what about the waiting so long overall?
From what I've heard, and I don't have perfect information, it's just rumor mill, they're going to do a traditional IPO. I think that when they pulled back, when COVID hit them hard at first, they took on a bunch of debt, and I think they want to raise capital. The direct listing does not currently allow you to raise capital, although the NYSE, Stacey Cunningham, is working with the SEC to try and make that happen. It's totally doable. And so I think they're going to go the traditional route.
Okay, but how much have they lost by waiting this long overall? I mean, there's an argument to be made it could have done years ago.
There's a small set of people that happen to be people that I highly respect. And the public side, it's like Rich Barton and Mark Benioff and Reed Hastings and Toby at Shopify. And if you just do Google searches, you'll see they all say the exact same thing I'm saying, which is companies are too afraid to go public. And there are massive benefits to being first in category, being public, having control of the narrative with the buy side. Spencer Raskoff wrote a long blog post on this subject, which you could also go find and read. But there were voices in Silicon Valley about 5 or 10 years ago that I think were mostly raising late stage funds and wanted to kind of to pick off the investments before they got public that started this stay private longer thing. But I've always equated it to, I always like the analogy of football, which is if there were some college quarterback that was, in the top 50 list of the draft that held a press conference and said, I don't think I'm going to go into the NFL yet because I'm really afraid of scrutiny. And, they track every single stat, and I don't want to be that short-term oriented. If someone did that, they would fall immediately. But that's the behavior of some of the founders in Silicon Valley that buy into this stay private thing. Like the minute you started giving stock to your employees, you're in the game. And your job is to maximize shareholder value for all your constituents, your investors, your employees, everything else. And so if you don't want to keep raising your game, you should sell your company or maybe consider hiring a CEO that that's my point of view.
Speaking of CEOs, obviously you were one of the earliest investors in Uber. Dara Khosrowshahi at Uber has been doing a bit of deal making here and there, buying and selling bits of the business worldwide. What do you think about his vision as a leader? For example, by spinning off self-driving into a subsidiary, it doesn't rely on Uber funding, but isn't necessarily aligned with Uber's bigger goals either.
I think there's a lot of positive things happening at Uber. Obviously, their decision to be more diversified, both from a geography standpoint by being global and with the Eats business, puts them in a place where they just have a lot more going for them than anybody that's single category. And I think the buy side's getting excited about that. I think the place they're in right now is there's a lot of investors that have interest. They see the possibility for the stock moving a lot higher, but they want the company to prove that they can get to cash flow positive. And I think until the company's talked about that and they've set future goals for it, but I think when they achieve that is when you're going to see the real value unlock.
Now, I know you got a strong opinion on AB5. Uber is relying on California voters to decide whether drivers should be freelancers or full-time employees. You have a strong opinion about it. If California doesn't vote Uber's way, how much could that hurt the company's future growth prospects?
Well, it's just one state, and to the extent that Uber and Lyft hold up their commitment that they're not going to operate here, I think that will be felt pretty profoundly across the community. We spent 100 years building this country around car ownership, which is regressive and a whole bunch of other things. And the world, would be better off if we lived in denser cities and had less car ownership. And this is a path to help get us there. The other point, which I think people really don't think about, actually there's two. One is, 5 million people committed to being drivers during the lowest unemployment in our lifetime. So the notion that this is just a horrendous job, that it flies in the face of 400 years of microeconomic study. Like those people could have gone to McDonald's or Starbucks or Walmart or wherever, but they didn't. They were opting in voluntarily. No one forced them, hey, go be an Uber driver. And the reason that they wanted it was the second reason, which is you have untold flexibility in when you can go to work. No one is trying to pass a law that says Starbucks and Walmart and McDonald's, you have to let people show up for work whenever they want, and because flexibility is an employment benefit right. No one's saying that. So there's this benefit in this job type that's super helpful to people that are in different stages of life, trying to pay down debt, trying to put themselves through school, trying to be a work-at-home parent. Like this is super beneficial to. And so the bottom line that everyone should understand, because I think this may be unprecedented, is the editorial board at almost all of the large California-based newspapers have come out and said that AB5 is BS. And they've all written editorial. I don't think that's probably ever happened in a movement that's targeted against a corporate entity before. And the reason is because they all know the lineage of this thing. The SEIU and other unions leaned on the Sacramento legislature to write a law targeting an industry they don't even represent, which I think is also crazy. Like it'd be like Nevada passing a law that impacts California residents. That's what's been happening here. And the papers have figured it out and they've written it. It really, as I've said before, like if you hate Citizens United, if you don't think corporations should write legislation in DC, you should hate AB 5 because it was written by political donors.
Now, there are so many questions about the pandemic, the recession, layoffs, and how that will impact Silicon Valley long-term real estate as we're all in this remote work situation. What do you think the most dramatic changes will be in Silicon Valley in a new normal? What is different after this?
I think it's super hard to predict, Emily. Like right now, there's some pretty dynamic things happening. You know, people struggled with building large engineering teams here anyway because it was just so competitive and expensive. And so, you know, just overnight, when you need a marginal hire, every company is going, well, maybe that person could be remote because everybody else is already. And so you have this kind of instant leakage in that area. We are now backing startups without offices, which isn't something we had done before. Not, you know, but we do early stage investing. We back companies with 5 to 10 employees, and they're founding those without an office. And in a lot of times, you end up taking on geographic diversity because you're not thinking about there being an office. And so there are people on the real far end of this argument. So Rich Barton at Zillow, I saw Dropbox's announcement that they're going to try and be virtual most, which is radically different than what's happened in the past. I've also met founders and CEOs like Reed Hastings who say, no, we need to be in the office. So I hate to answer a question with uncertainty, but I don't think we know how this is going to play out.
Now, there's a big question about the future of big tech right now. Talking about regulation earlier, Keith Raboy was on the show last week saying he thinks this House report that could pave the way to a big tech breakup is one of the dumbest pieces of paper he's ever seen. You covered some of these companies in their infancy when you were on Wall Street.
Yeah.
Do you think that Apple, Amazon, Google, and Facebook are monopolies? Should big tech be broken up? I got about 2 minutes left.
Okay. Well, the one thing I'd say that I think is provocative on this front that's maybe inconsistent with Keith's point of view is I actually believe in my heart of hearts that the government restricting Microsoft's ability to leverage their way through the browser opened the door for Facebook, Google, Amazon. If they had been able to tie the browser to search the way they did, you know, the way they went after Netscape aggressively, I think they would have succeeded. They're really good at that stuff. And so the irony perhaps is that I think the government doing this in the past created the window for many of these companies. And so I'm torn from that point of view. I will say that you know, we back smaller companies and having them interact with these larger companies, boy, you feel the power. Like you don't have one-way or two-way negotiations. It's my way or the highway. So if I think
does that
purely
mean
as
breakup? I mean, do you think that's an argument? Is that an argument for breakup?
I don't know. I mean, by the way, you know, the Microsoft or the government going after IBM paved the way for Microsoft, right? And that's written in books like Big Blues. It's very clear. So, you know, and there are people like Jeremy Stoppelman who feel like his content was stolen. And so I do think that there is a point at which the leverage becomes so large, like this 30% thing that they're forcing arbitrarily on certain industries, that you got to ask the question. And maybe the pressure causes the behavior to change, and that's good enough. So I don't know if you have to take it to the extreme of breakup, but I do think you have to pay attention.
All right. Bill Gurley, always love having you on the show and appreciate
Thank you.
A counterpoint of view. Benchmark Capital partner Bill Gurley, thanks so much for stopping by. All right, coming up, Zoom has hit a new record after unveiling its latest products at its Zoomtopia 2020 event. We're going to get the latest from the company's CFO next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Zoom is rolling out end-to-end encryption for user calls seeking to sidestep safety concerns and maintain its growth. The security feature will be generally available to free and paid users starting next week. Zoom has been a prominent beneficiary of the coronavirus disruption to normal life, which has forced millions of us to work, study, and socialize from home. To discuss, we are joined by Zoom CFO Kelly Steckelberg. And Kelly, you are wrapping up your Zoomtopia investor event right now. So thank you so much for taking the time to join us. I want to start with this end-to-end encryption, which is a dramatic change. How will this change my Zoom experience?
Yeah, so we announced at Zoomtopia, our users conference, that end-to-end encryption will be available in technical preview next week. As you said, it's going to be available for both free and paid users. And what this means is that users that are on the Zoom client will have a higher level of security and privacy added to their meetings, and that the encryption keys will be generated by the participants' machines themselves and known to no third party, not even the Zoom servers. So it will be a really high level of security that will be combined with the reliability and the scalability and the quality of Zoom video and our platform.
So now that we've sort of stabilized in pandemic mode, with some people going back to work, but many of us still at home for the foreseeable future, what's your outlook on growth? Do you see demand still accelerating, and if so, how much?
So, we've had a really amazing experience over the last 6 months. And I think to talk a little bit about some of the results, first of all, what we've seen is growth in this cohort of customers with fewer than 10 employees. If you look at our results from Q4 of FY20, that represented 20% of our revenue. And in Q2 of FY21, just our last quarter, it was up to 36%. And so that's a tremendous growth. And this is really, an expansion of a cohort that historically, before the pandemic, we had really been primarily focused on our upmarket enterprise customers. And now as we've seen this growth, we're really listening to and focusing on these customers. And with that, really excited that we announced yesterday our On Zoom, which is a one-stop location for small businesses and consumers to come together to host events. And we've all seen this. I'm sure this is happening in your household where there are things like piano lessons and yoga lessons happening, but it's been a very disparate experience. And so what we're doing is really trying to streamline this experience for these small business owners and their consumers to come together on Zoom and be able to have a unified, consistent experience. So really excited to announce this and to see where it goes. And we think looking forward, this is obviously going to continue to be a really important part of our long-term strategy. And then in the upmarket, what we have seen is companies have continued to buy. They've expanded now beyond their business continuity planning into really thinking about, for the long term, how are they going to bring their employees together in a safe and efficient way. And so another announcement that I loved from yesterday was our Smart Gallery. And this is part of our Zoom Rooms solution, which what Smart Gallery does is, we've all had this experience over the last 6 months in working together in this environment, that there's been a democratization of communication, is what I like to call it. Because when you get on a Zoom, everybody's square is the same size. And if you think about companies starting to want to go back and put their employees maybe in a hybrid approach, and some are in the office and some are at home, how do you keep that? How do you keep that benefit that we've achieved and not have somebody who's like working from home and everybody else is in the office, like looking at the back of someone's head? And that's what Smart Gallery is going to do. It's going to enable us to have that appearance that we're still on the screen together.
You unveiled On Zoom, which is this solution for folks who want to host and monetize events. I know you said it's not initially material to revenue, but what about the mid to long-term potential in terms of having a platform that can offer virtual experiences? How much revenue do you expect this to drive in the future?
Yeah, well, we're at really early stages as we just launched this, but what we're excited to do is learn from our hosts, learn what's important to them, listen to them, and see how they and their customers come together to leverage this platform. And initially, really focused on the small and mid-sized businesses. But I think in the future, we're going to start to see larger events being hosted there, and maybe even enterprises want to leverage this platform. So I think there's a lot of potential. We're just at super early days of the cycle.
Obviously you've now got Zaps allowing others to embed their apps onto the Zoom platform. Eric Yuan, your CEO, yesterday talked about the importance of cooperation. But when it comes to companies like Microsoft and RingCentral that are also competing for your customers, what is the line between competition and collaboration?
Yeah, so everything we do at Zoom is focused on delivering happiness to our customers. And we believe that means sometimes we really cooperate and work very closely with companies to ensure that our customers get this best of breed approach, but that we come together and work seamlessly. A great example of that is our API integration with Slack, for example. But on the other side of it, there is competition, but we believe that competition makes us all be better and is good for the consumer. We don't take it for granted. We're very paranoid about our competitors, and that drives us every day to be on the forefront of development and thinking about what we can do to support our customers every single day. And, I think, Eric, what you're referring to also is Eric did talk about there are times when customers want to use aspects of other platforms like Microsoft, and we also provide an integration there so that, again, our customers can use the products that they love and come together with Zoom for video communications and also our Zoom Phone application, which are really the key components of our platform.
Now, I know the team has been working very hard to improve the security features and shake off that sort of early Zoom bombing issue reputation. Congresswoman Jahana Hayes of Connecticut recently spoke about racist trolls attacking her during a Zoom town hall. Do you think the company has done enough to prevent disruptions like this? And if not, what else do you think the company can do?
Yeah, so we've learned a lot during the last 6 months, and security and privacy is now front and center and embedded into everything that we do. I often get asked, are we done? We will never be done. It is now part of every design, every product that we put forward. We think about this, and it is ongoing. It takes diligence, it takes commitment. And it's a combination of education, helping that our users know how to best use our platform, how to best equip them with things like features and functionality that allow them to keep their meetings secure and safe. One of my favorite ones is our Privacy Shield, that when you're hosting a meeting, it puts all of these features and functionality front and center. And it's also helping educate them about the best way to communicate with attendees in meetings. Not, for example, publishing meeting credentials publicly that makes them accessible to anyone. We're also working with AI to ensure that when we do see situations where meeting credentials are publicly available, that we're doing everything we can as quickly as possible to make those be private again. So we take this very seriously, and we're spending a lot of time as a company, obviously always thinking about how to keep our users and meeting participants secure.
All right. Kelly Steckelberg, CFO of Zoom. Kelly, thanks as always for stopping by. Still ahead, General Motors' Cruise unit takes to the streets of San Francisco, now permitted to test 5 driverless cars in the city without safety drivers. More on the race to autonomous vehicles with the CEO of Cruise, Dan Ammann, in an exclusive conversation next. This is Bloomberg. Full speed ahead for Cruise. The General Motors unit will be allowed to test autonomous cars on public roads in San Francisco without a safety driver, joining Amazon-backed Zoox and a select group of other self-driving startups with the special permit. Joining us now for an exclusive conversation, Cruise CEO Dan Ammann. He has helped Cruise raise $7.25 billion in committed capital, attracting the likes of SoftBank, Honda and T. Rowe Price. Dan, thanks so much for joining us. Good to have you back here on the show. So you're going to test fully driverless cars in San Francisco starting this year. Initially, just a small fleet, 5 cars. How hopeful are you about expanding and growing the testing in San Francisco?
Well, we're obviously incredibly excited to have reached this milestone, and it represents the culmination of years of work by thousands of people. So it's awesome, but at the same time, it's really just the beginning of what comes next. And what we're obviously focused on, overall, is ultimately making a really big positive impact on transportation. And to do that, we obviously need to deploy this technology and these vehicles at a very large scale. But we are going to step into that in a very thoughtful and responsible way, and gradually increase our capabilities and presence, and make sure that we're building trust in the technology as we do that.
So the big development here is no safety drivers. What are the safety mechanisms to avoid accidents? I am a San Francisco resident. Should I be worried about these cars roaming the streets of San Francisco?
Well, I'd say, first of all, safety is the number one priority at Cruise, and that's the focus, the first focus that we have, and the focus in everything that we do. We have more than 2 million miles of testing that we've been doing in the city with backup drivers, and the technology has now developed to the point where we believe we're ready to take that very next step and do it at a very small scale initially. Take that next step and deploy without somebody behind the wheel. But we have very extensive safety protocols in place on top of all of the testing that we've done. And again, our goal is to really build trust in this technology and to step into it in a very, very responsible way.
Now, Elon Musk has suggested that autonomous startups like Cruise, like Waymo, that your cars are better suited to small, specialized situations, geo-fenced locations, and not for traveling widely. What is your response to that?
Well, our focus at Cruise is really to solve the problem of transportation where it's where it's most acute and where the real transportation crisis is, and that's in our cities. And that's why we've chosen to develop our technology to work in a very, very complex environment, like San Francisco, so that we can really solve the problems of transportation where they're most serious.
So, will we see you test the commercial service outside of California?
For sure. I mean, our goal is to deploy this technology ultimately at very, very large scale and solve the problems of transportation, not just in San Francisco, not just in California, but frankly, ultimately across the world. Everywhere you look, transportation today is too dangerous, too dirty, too time-consuming, and too expensive. And we believe self-driving technology can make a huge positive impact on all of those, and just give all of us time back, make travel safer and more accessible for everybody.
So what will be your first foray into commercial driverless cars? Could it be autonomous food delivery, for example?
Yeah, we see a lot of different opportunities. I think the two most obvious ones, of course, are moving people, so autonomous ride-hail service, and then also delivery of goods is another huge market opportunity, and we expect to pursue both of those in the not too distant future.
What about driverless freight? Is that something that's on your radar?
Yeah, for sure. I mean, I think once the technology is has matured and has been proven to be effective at large scale, there's a whole host of opportunities. So I think anything that's on the road and is getting driven today conventionally is an opportunity for us.
And talking about the economics of an autonomous shuttle, you've got this permit from the California Public Utility Commission to give rides to the public, but you can't charge a fare. Should they let you charge a fare?
Well, eventually, of course, to run a business, we need to charge a fare and generate revenue to cover our costs. So that will be an important step along the way. But more importantly, I would say one of the things that we do believe that we'll be able to do is to provide transportation to people at a much lower cost than the other alternatives they have today. So today, people can take a cab, or they can take a ride share, or they can drive themselves. But there's a lot of people that don't have accessibility to transportation, can't afford those alternatives, don't have access to public transit necessarily, and our goal is to make transportation super affordable and super accessible for everybody, and we think that's one of the unique opportunities that self-driving technology can bring to our cities.
So how do you see the economics for an autonomous shuttle actually adding up for crews?
Well, we know today how much people pay to get around, right? We know what people pay to take, a cab or a rideshare, or what they pay to own and operate their own car. And our goal is to be able to deliver a service that's more convenient, safer, and at a much lower cost than those other alternatives. And so we know where our costs need to be able to do that, and we're working very hard to get to that level. One of the big advantages we have at Cruise is the Cruise Origin, which is our purpose-built self-driving vehicle, which is in very advanced development now. We showed that to everybody back in January, and one of the reasons we decided that was the way to go, to develop a purpose-built vehicle rather than retrofitting to some other vehicle, is it gives us obviously a much better vehicle and a better experience for the customer, but it gives us a huge cost advantage and allows us to be able to offer transportation to folks at much lower price levels.
All right, well, we'll be watching as these hit the road. Cruise CEO Dan Ammann, thank you so much, Dan, for joining us today. Still ahead, despite the COVID-19 induced recession, Hewlett-Packard Enterprise outlook for next year beyond Wall Street estimates. We're going to speak to the CEO next about how they plan to achieve. Another exclusive conversation coming up. This is Bloomberg. Hewlett-Packard Enterprise announced a rosy outlook for fiscal year 2021 in its virtual securities analyst meeting today. The company, the pandemic has been a catalyst for the company to accelerate its services to help other companies in their digital transformation. Joining us now in an exclusive interview, Antonio Neri, CEO of HPE. Antonio, great to have you back here on the show. So what's behind the rosy outlook?
Well, Emily, good afternoon. Thanks for having me today. I think we laid out a very compelling case for investing in Hewlett-Packard Enterprise because we believe we have a unique opportunity to help customers transform their business through the digital technologies we saw early on, and COVID has been a great catalyst to an acceleration. As I said in my earlier remarks today, it's no longer a strategy, but it's a strategic imperative. And we have a unique vision to deliver edge-to-cloud experiences as a service. And we have a unique set of assets that can accelerate that transformation for customers. And that's why we see growth in many areas of our portfolio that over the next 3 years are going to continue to shift the mix of our revenue and margins with margin expansion, which ultimately will drive very strong shareholder returns.
On the other hand, the pandemic has ushered in a recession, which means that a lot of people and a lot of companies are hurting. How has that impacted demand?
Well, obviously, early on this year and throughout the summer, there has been an impact on demand and a significant disruption to the supply chain. I think our company has done a remarkable job in just 90 days recover the supply chain execution. As we said at the end of Q3, we reduced our backlog by more than $500 million and are incredibly confident to deliver the what I call normalized level of backlog as we exit this quarter, which is in a couple of weeks from now. But the demand now is steady, Emily. We see a strong demand in many areas of the portfolio with remote connectivity, return to work solutions. Aruba is a great aspect of our offering that allows customers to provide that secure remote connectivity. We live in a very large distributed enterprise. Obviously, more than 45% of the people are already working from home, and we believe that trend will continue. And so the ability to connect what I call now the micro branches, which are your home, to the cloud is a necessity, obviously in a secure way. And we have a perfect solution for that, also because we just completed the acquisition of Silver Peak. And then you need to process all this data. The future belongs to the fast. And those who can extract the insights from the data will be the winners, and those who will be more digitally native. And so our high-performance computing business, our compute and storage, and the ability to consume as you go. And that's where our HP GreenLake Cloud Services is absolutely a point of differentiation for us. Last quarter grew 82%.
Now, server sales often weaken in an economic slump. Curious if you think server sales can or will pick up without an economic recovery.
We believe as we go forward, the recovery on compute demand will be there, driven by the fact that we will continue to pivot these technologies to more dense solutions. And solutions like hyperconverged or disaggregated hyperconverged that we have unique advantage is actually based on a server. And so we expect 2021 to see a rebound on the compute side and also on the high performance compute, which the market is growing. You know, we show the TAM today in excess of $35 billion, and the top side of the market, which is the exascale, is growing 14%. And we have won 80% of those deals. So we are very confident about that and our ability to execute.
Now, HPE servers are used by many governments, and we are approaching a very contentious presidential election. Is HPE doing any work to secure these environments?
Well, actually, glad you asked, Emily, because just last week we introduced the most secure server on the planet. These servers are made in the United States and manufactured in the United States. And it's not just the silicon root of trust we have in the servers, but our secure supply chain that's unique and differentiated. And that's why our servers are used not just in the public sector, but in the financial sector and also in healthcare verticals. So we have, again, another point of differentiation there too.
You've also been recording more revenue from subscription services. What sort of evidence are you seeing that customers are more likely to get new hardware under a subscription model versus otherwise?
Well, customers want the cloud experience with the flexibility and control of the on-prem solution. And what we see, Emily, is that there is a lot of workloads that are very data intensive, where data has gravity. And therefore, they still want to consume it as a service, but their own premises. And the market on premise is growing from $6 to $22 billion. And we just announced today, you know, we won a very large deal where the Splunk workload was built on the cloud, but actually consumed on-prem. And we expect that market to grow very rapidly at 60%.
Antonio Neri, CEO of HPE. Good to have you back on the show. Antonio, thank you so much for joining us today. And that does it for this edition of Bloomberg Technology. I am Emily Chang in San Francisco. Bloomberg Daybreak Australia coming up next. This is Bloomberg.